I'm Doris. We're going to talk about the market updates today. The Republican negotiators said that there are still thorny issues unresolved in the negotiations, yet they did agree to lift up the debt ceilings for the next 2 years. The yen fell below 140 and the whole market is going short. Be aware of the Bank of Japan's sneak attack. U.S. Representative Patrick McHenry said on Saturday that there is still a thorny issue in the debt ceiling negotiations between the House Republicans and the White House. In hours or today, I don't know when it'll be, McHenry, one of the top negotiators, said at the Capitol. He added that there are only a few differences left. McCarthy and the President Joe Biden's negotiators worked late into the night to eliminate the threat of the default, which Treasury Secretary Janet Yellen said could occur on June 5th. McHenry said passing the bill before the deadline was a severe challenge. McCarthy has promised to give lawmakers 72 hours to evaluate the text. McHenry said the Republican position has not changed. The rule, combined with procedural hurdles in the Senate, could drag matters back to the June 5th deadline. UBS believes the Bank of Japan will adjust its YCC policies on having July to October due to good economic data, better than expected growth, and core CPI continuing to rise. While the difference between Japan and the U.S. in interest rate pressures, the Japan underlines the divergence in monetary policy. Some analysts believe the trend is about to reverse and that the Bank of Japan is likely to start adjusting its YCC policy in the coming months. The yen has fallen more than 6% against the dollar since the start of the year, and is now trading at 140.59, the lowest level since last November. Last year, the yen used 9.1 trillion yen, or $65 billion, to support the yen after it fell to 145.9 for the first time. Selling the yen is the preferred macro strategy for hedge funds in 2022 at the time when Fed raised interest rates, while the Bank of Japan maintained ultra-loose monetary policy. The traders also increased their short positioning in the yen as the yen continued its losses and bets that the Fed would continue to raise interest rates. Leveraged funds increased the number of short yen contracts to 53,706 in the coming week, ended May 23rd, the highest level since June according to the Commodity Futures Trading Commission, but analysts don't think the yen will plunge as it did last year. This year is very different. Not only did the Bank of Japan have no comment on the yen's decline, but analysts say the yen is unlikely to bottom below 145. The yen is likely to bottom out around 142 to 3, supported by improved trade accounts and higher visitor numbers, the market risk consulting firm said. Agency researcher Koji Fakaya said the situation was different from last year, especially since the deficit is much smaller, and the rebound in the inbound tourism and trade accounts limited the downside of the Japanese yen. There were not enough factors to pull the yen down below 145 and down to 150. Analysts are betting that the yen's losses are about to reverse. While the difference in interest rates between Japan and the U.S. underscores the divergence in the monetary policy and weighs on yen, some analysts believe that the trend is about to reverse. The yen is expected to rise to 127 by fourth quarter, according to median forecast analysts surveyed. The reason given by analysts is that first, Japan's economy is improving. Japan's trade deficit has narrowed from a seasonally adjusted high of 2.4 trillion yen, while the country saw more than 1.9 million foreign visitors in April, about two-thirds of the pre-outbreak level, and economists expect a further recovery. Second, global money is also pouring into Japanese stocks, where Japan's benchmark Topix index hit a 33-year high last week. Foreign non-resident investors became net buyers for the 8th straight week, spending more than Y7 yen in the period ended May 19th, according to official government data. According to reports, Taisaku Ueno, chief currency strategist at Morgan Stanley Securities, said, "We don't even see a verbal intervention these days because the 140 level is not as worrying as last year, and the Japanese stock market performs very well with a weaker yen. Crude oil prices have also fallen, and inflation concern about the weaker yen and rising import prices have eased." The Japanese government officials have also made a statement. On Friday, Japanese Finance Minister Junichi Suzuki said at a press conference after a regular cabinet meeting that the market should set the foreign exchange rate after the yen falls. The exchange rate should be determined by the market based on the economic fundamentals. We will continue to closely monitor the market movements. UBS believes the Bank of Japan will adjust its YCC policy sometime in October to raise the 10-year Treasury yield target by at least 5 points, due to better than expected economic growth and continued core CPI by 25 basis points to 0.75%. Meanwhile, the latest Fed minutes suggest the need for further U.S. rates has become less certain. As a result, UBS expects the yen to rise to 122 by the end of the year, up 15% from now. The governor of Bank of Japan said the policy flexibility very different from the former governor, Haruhiko Kuroda. Mr. Teta recently said he would not rule out the policy changes even if inflation falls below the 2% target. Societe Generale expects the yen to rise 7% in the coming weeks. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.